Imagine this. You've worked hard, saved some money, maybe even started investing. But one by one, tiny decisions, unconscious habits, and avoidable slip-ups quietly drain your wallet. Before you realize it, years of effort have evaporated. And here's the scary part. Most people don't even know they're making these mistakes until it's far too late. That's exactly why we're here today. In this video, we're diving deep into the top 10 biggest money mistakes people make, and more importantly, how you can avoid them. This isn't about abstract financial theory or complicated jargon. It's about real-world traps that millions fall into every single day, costing them financial freedom, peace of mind, and opportunities for wealth. Think about it. Would you ever leave your front door wide open while going on vacation? Of course not. Yet when it comes to money, countless people leave their financial doors unlocked, letting poor planning, unnecessary spending, and emotional decisions rob them of security. Here's the truth. Wealth isn't only about how much you make. It's about how much you keep, grow, and protect. Even people with high incomes can end up broke if they repeat these mistakes. On the other hand, ordinary earners who avoid them can build comfortable, stress-free lives. So whether you're just starting your financial journey, already building wealth, or even recovering from past setbacks, this video will shine a spotlight on the hidden pitfalls you must sidestep. Stick with me till the end, because the final mistake might just be the silent killer of financial success, the one almost everyone ignores, yet it quietly destroys fortunes. Ready? Let's jump straight into money mistake number 1. Money mistake number 1, living beyond your means. Let's start with one of the most common and damaging money mistakes, spending more than you earn. It sounds obvious, right? Yet millions of people, from students to professionals with six-figure salaries, fall into this trap every single day. Why? Because it doesn't happen all at once. It creeps up slowly like a leak in the roof. A little splurge here, a buy now, pay later there, and before you know it, you're living in a cycle where your lifestyle costs more than your paycheck covers. The psychology behind it. We live in a world where we're constantly bombarded with advertisements. Social media shows us highlight reels of people's lives, vacations, cars, designer clothes, the newest tech gadgets. And subconsciously, we feel pressure to keep up. Even if we can't actually afford those things, the temptation to buy them anyway is overwhelming. This is lifestyle inflation. As our income grows, our expenses rise with it, sometimes even faster. But here's the hard truth. If your expenses are always equal to or greater than your income, you'll never build wealth. You're running on a treadmill that never stops, and no matter how fast you run, you stay in the same place. Real-world example. Take two friends, Alex and Sam. Alex earns $60,000 a year, while Sam earns $100,000. On paper, you'd think Sam should be wealthier, but here's the difference. Alex lives in a modest apartment, drives a used car, and saves 20% of every paycheck. Sam, on the other hand, buys a luxury car on loan, rents an expensive apartment downtown, and spends lavishly on eating out and gadgets. Fast forward 10 years, Alex has saved and invested steadily, building a solid financial cushion. Sam, despite earning more, has little to no savings and a mountain of debt. The lesson? It's not how much you make, but how much you keep. How to avoid this mistake. So, how do you make sure you don't fall into this trap? Number 1, create a realistic budget. Track your income and expenses. Write it down, or better yet, use apps like Mint, YNAB, or a simple Excel sheet. Seeing where your money goes each month will open your eyes to unnecessary leaks. Number 2, follow the 50-30-20 rule. A simple rule of thumb is to spend 50% of your income on needs, rent, groceries, bills, head-on wants, entertainment, dining out, and at least 20% on savings and investments. If you can push savings higher, even better. Number 3, delay lifestyle upgrades. Got a raise? Great. But instead of immediately upgrading your car, apartment, or wardrobe, consider keeping your lifestyle the same and banking that extra income. That's how wealth is built quietly over time. Number 4, avoid debt-fueled spending. Credit cards and installment loans make it easy to live beyond your means. Unless you're paying the full balance every month, carrying debt for lifestyle expenses is like digging a financial hole you'll later struggle to climb out of. Mindset shift. Living within your means doesn't mean living without joy. It means prioritizing what really matters. Do you really need 5 subscription services? Do you really need a brand new phone every year? Often the answer is no. By cutting back on the noise, you free up resources for things that bring genuine value, like experiences, education, or investments. Remember this: wealthy people look rich because of what they own. Truly rich people stay wealthy because of what they don't waste money on. Closing. Thought for mistake, number 1. Living beyond your means is like sailing with a hole in your boat. No matter how hard you row, water keeps pouring in. The first step to financial freedom is patching that hole by spending less than you earn, saving consistently, and letting time and discipline do their work. So, if you want to stop money stress from running your life, begin by mastering this simple principle. Always live on less than you make. Money mistake number 2, not having an emergency fund. Picture this. You're driving to work and suddenly your car breaks down. The repair costs $800. Or maybe your company announces layoffs and overnight you're out of a job. Or worse, a medical emergency arrives when you least expect it. Now here's the question. Would you be able to handle that sudden expense without going into debt? Borrowing from friends or draining your credit card? For far too many people, the answer is no. And that's why not having an emergency fund is one of the most dangerous money mistakes anyone can make. Why it matters. Life is unpredictable. No matter how well we plan, unexpected expenses will always come, and usually at the worst possible time. Without a financial safety net, even small emergencies can spiral into major crises. Think about it. A single missed paycheck could mean falling behind on rent or bills. One medical bill could trigger months of debt, and when you're forced to rely on credit cards or loans, you end up paying far more in interest than the original emergency cost. That's why financial experts agree an emergency fund isn't optional, it's essential. It's not about if something unexpected will happen, but when. Real-world example. Let's compare 2 people, Rachel and Daniel. Both earn the same salary and have similar lifestyles. One day, both face an unexpected $1,000 car repair. Rachel has no savings. She puts the bill on her credit card, which charges 22% interest. She can only afford minimum payments, so that $1,000 turns into $2,400 over time. Daniel, on the other hand, has built an emergency fund with 3 months of expenses. He simply dips into his fund, pays the bill, and later replenishes it. Stress-free. This is the power of an emergency fund. It turns potential disasters into manageable inconveniences. How much should you save? So how big should your emergency fund be? Experts usually recommend 3 to 6 months worth of living expenses. If your monthly needs, rent, food, bills, transportation, add up to $2,000, your target emergency fund should be between $6,000 and $12,000. But here's the key. Don't get overwhelmed by the big number. If you're starting from zero, focus first on building a mini fund of $1,000. That alone can cover most unexpected car repairs, home fixes, or medical copays. Once you hit that milestone, keep building until you reach the 3 to 6 month range. Where to keep it? Your emergency fund should be easily accessible but not too easy to spend. The best options include a high-yield savings account, money market account, or a separate bank account dedicated only to emergencies. Avoid locking it in investments like stocks or real estate. Those can lose value or take time to liquidate, defeating the purpose of quick access. How to build it fast. Number 1, automate your savings. Set up an automatic transfer every payday into your emergency fund. Even $50 or $100 a month builds momentum. Number 2, cut back temporarily. Skip eating out for a month, cancel unused subscriptions, or sell unused items. Redirect that money into your fund. Number 3, use windfalls wisely. Got a tax refund, bonus, or side hustle income? Instead of spending it, use it to grow your emergency cushion. Mindset shift. Think of an emergency fund as insurance for your financial life. You hope you'll never need it, but when you do, it's priceless. And it's not about paranoia, it's about peace of mind. Imagine the freedom of knowing that no matter what happens, job loss, medical issue, or car trouble, you can handle it without panic. That's real financial security. Closing thought for mistake number 2. Not having an emergency fund leaves you vulnerable, like walking a tightrope with no safety net. One slip and the fall is devastating. But with even a modest emergency cushion, you transform those slips into minor bumps. So, if you haven't started yet, today is the best day to begin. Build your emergency fund step by step and give yourself the gift of financial stability. Money. Mistake number 3, carrying high-interest debt. If there's one silent thief that robs people of wealth more than anything else, it's this: high-interest debt. Credit cards, payday loans, and certain personal loans are designed to trap you in a cycle where you end up paying far more in interest than you ever borrowed in the first place. The reality of high-interest debt. Here's the truth. When you carry a balance on a credit card with an interest rate of 18%, 20%, or even 25%, you're essentially renting your own money back from the bank. The longer you take to pay it off, the more the interest snowballs, and the debt grows faster than most people can keep up with. Let's put it in numbers. Say you owe $5,000 on a credit card at 20% interest. If you only pay the minimum each month, it could take you over 20 years to clear that debt, and you'll have paid more than $10,000 in interest alone. That's 2 or 3 vacations, a down payment on a car, or even a chunk of a home deposit wasted. Why people fall into this trap? There are 3 main reasons people carry high-interest debt. 1, living beyond their means, as we covered earlier. Overspending leads directly to credit card reliance. 2, emergency expenses. Without a safety net, people swipe cards to survive, creating long-term burdens. 3, lack of financial awareness. Many don't truly understand how fast interest accumulates. The minimum payment seems manageable, but it's a dangerous illusion. Real-world example. Let's take Sarah. She lost her job and started covering living expenses with her credit card. In just 6 months, her balance grew to $8,000. Even after finding a new job, her monthly payments barely made a dent because interest kept piling on. For years, she struggled. Not because she wasn't earning enough now, but because she had chained herself to past debt. Contrast that with James, who faced a similar situation but had an emergency fund. Instead of relying on credit cards, he used his savings, stayed debt-free, and rebuilt his fund later. The difference? One is still stuck paying for yesterday's problems, the other is building for tomorrow. How to avoid or escape high-interest debt? The good news is, no matter how deep the hole feels, there are ways to climb out. Number 1, stop adding new debt. First rule, cut the card. If you keep swiping while trying to pay down balances, you're running in circles. Number 2, debt avalanche method. List all your debts. Pay the minimum on all and throw every extra dollar at the one with the highest interest rate. Once that's cleared, move to the next. This minimizes total interest paid. Number 3, debt snowball method. For people who need motivation, start by paying off the smallest balance first. The psychological win of eliminating debts builds momentum. Number 4, negotiate lower rates. Many don't realize this, but you can call your credit card company and ask for a lower APR. A few points off can save thousands over time. Number 5, consider a balance. Transfer. Some banks offer 0% intro rates for 12-18 months. If you're disciplined, this buys time to pay off debt faster without interest eating you alive. Number 6, increase income streams. Side hustles. Freelancing or selling unused items can accelerate debt repayment. Every extra dollar thrown at high-interest balances is a guaranteed return. Mindset. Shift. Think of high-interest debt as negative investing. While investments grow your money, debt shrinks it. Paying off a credit card at 20% interest is the same as earning a guaranteed 20% return on an investment, something you'd almost never find in the stock market. That's why eliminating debt is one of the smartest financial moves you can make. Closing. Thought for mistake number 3. Carrying high-interest debt is like filling a bucket with water while there's a massive hole at the bottom. No matter how much you pour in, it keeps draining away. Until you plug that hole, you'll never get ahead. So if you're serious about building wealth, make this your top priority. Attack high-interest debt with everything you've got. Because once you're free, every dollar you earn finally belongs to you, not the bank. Money mistake number 4, not investing early. One of the biggest habits that separates wealthy people from everyone else is starting early. Yet many delay investing, waiting until they feel ready or earn more. The truth is, the earlier you start, the less money you need to build wealth. The power of time. Take Emma and John. Emma invests $300 a month from age 25 to 35, then stops. John waits until 35 and invests the same $300 until 65. Emma invests only $36,000. John invests $108,000. Yet Emma ends up with more. Why? Compound interest. Time beats money. Why people delay? People hesitate because they fear losing money, don't know where to start, or think investing is only for the rich. But you don't need to be wealthy to start. You need to start to become wealthy. How to avoid this mistake? Begin with whatever you have, even $50, $100 monthly. Automate contributions, so investing becomes a habit. Use employer retirement plans, especially if they offer matching contributions. Stick with simple, low-cost index funds or ETFs. Increase your contributions as your income grows. Investing early is like planting a tree. The best time was 20 years ago. The second best time is today. Start now, even if small. Your future self will thank you. Money. Mistake number 5. Ignoring financial education. Most of us spend years in school learning math or history, but almost nothing about how money really works. That's why so many adults enter the real world knowing how to solve equations but clueless about budgeting, credit, or investing. Why it matters. Without financial knowledge, even smart people make mistakes. They take loans with high interest, fall for scams, or never plan for retirement. Financial ignorance doesn't just stop you from building wealth. It actively drains it because banks, lenders, and marketers profit from what you don't know. How to fix it. The good news? Learning about money has never been easier. Read books like Rich Dad, Poor Dad, or The Millionaire Next Door. Follow podcasts, our YouTube channels for free. Practical tips. Take online courses on platforms like Udemy, Coursera, or Khan Academy. Start small. Aim to learn one new financial concept every week. Think of money as a language. If you never learn it, you'll always struggle. But once you understand it, doors open. Smarter investments, stronger protection, and lasting wealth. Even 30 minutes a week spent learning about money is one of the highest return investments you'll ever make. Money mistake number 6, not planning for retirement. Retirement feels like something far away in the future. When you're young or even in your middle years, it's easy to tell yourself, I'll deal with that later. But here's the truth. Failing to plan early is one of the most damaging money mistakes you can ever make. Many people underestimate just how long retirement can last. Think about it. You could spend 20, 25, even 30 years of your life without a regular paycheck. That's decades where your bills don't stop, your health costs often increase, and inflation quietly erodes your purchasing power. Without preparation, you'll be forced to rely only on government benefits or small pensions, and those rarely cover the true cost of living. The nightmare scenario? Outliving your money and becoming financially dependent on your children, family, or even strangers. Why it's dangerous. Longevity risk. People are living longer than ever before. That's good news for life, but bad news if you haven't saved enough. Healthcare inflation. Medical costs tend to rise faster than general inflation, and older age means more doctor visits, treatments, or medication. Lifestyle maintenance. Retirement isn't just about survival. You want to enjoy hobbies, travel, and time with loved ones. Without planning, these dreams vanish. The common pitfalls. Number 1, starting too late. Many people wait until their 40s or 50s to save seriously. By then, you have fewer years for compounding to grow your money. Number 2, underestimating costs. Some assume retirement will be cheap, but expenses like healthcare, housing maintenance, and insurance can eat up a large chunk of savings. Number 3, relying on one source. Depending solely on Social Security, a pension or family is risky. Systems can change, companies can fold, and family members have their own struggles. How to avoid this mistake? Number 1, start now, no matter what. Even if you're young and broke, begin with small contributions. Compounding works like magic when you give it time. A single $100 monthly investment started at age 25 can grow into hundreds of thousands by retirement. Number 2, use employer benefits. If your company offers a retirement plan like a 401k with a match, take it. That's free money. Not contributing enough to capture the full match is like leaving part of your salary on the table. Number 3, diversify retirement accounts. Don't depend on one bucket. Use a mix. Employer plans, IRAs, or even personal investment accounts. The goal is to spread risk and maximize opportunities. Number 4, revisit regularly. Life changes. Marriage, kids, promotions, or even job losses affect how much you can save. Review your retirement plan at least once a year and make adjustments. Number 5, automate it. Set up automatic transfers to retirement accounts, so saving becomes a habit. Not a choice you might skip. Mindset shift. Planning for retirement isn't about sacrificing your happiness today. It's about securing freedom tomorrow. Imagine being 65 and not worrying about bills, not fearing medical emergencies, and not depending on anyone. Imagine being able to travel, spoil your grandkids, or simply enjoy peace of mind. That's what retirement planning buys you: options and dignity. Not planning for retirement is like building a house without a foundation. It might stand for a while, but eventually cracks appear and it collapses under pressure. The earlier you start, the stronger and safer your future will be. So don't wait for later. Later becomes too late. Begin today, even with small amounts. Because when it comes to retirement, the greatest gift you can give yourself is time. Money. Mistake number 7, neglecting insurance. Most people don't like paying for insurance. It feels like money wasted. After all, you're paying for something you hope you'll never use. But skipping insurance or having the wrong kind is one of the costliest mistakes you can make. The irony is, people avoid insurance to save money. But when disaster strikes, the lack of protection ends up costing them everything. Why it's dangerous. Life is unpredictable. A single medical emergency, a car accident, or damage to your home can wipe out years of savings in just a few days. Without proper insurance, many people are forced into debt, bankruptcy, or years of financial struggle. What makes this mistake especially dangerous is that unexpected events don't give warnings. Nobody schedules accidents. Nobody plans for cancer. Nobody expects a sudden house fire. Yet these things happen to ordinary people every day. And those without protection end up paying the highest price. The common mistakes. No health insurance. Medical bills are one of the leading causes of bankruptcy worldwide. Even one hospital stay can cost tens of thousands of dollars. Without insurance, it's nearly impossible for most people to recover financially. No life insurance. If a breadwinner suddenly passes away, the family is left not only grieving, but also struggling to pay bills, mortgages, or education costs. Life insurance ensures your loved ones are financially secure if the worst happens. Skipping disability insurance. People rarely think about what would happen if they couldn't work for months or even years due to illness or injury. Without disability coverage, your income dries up, but your bills don't stop. Underinsuring property. Many buy the cheapest auto or home insurance, only to discover later that their policies don't actually cover what they need. In the end, cutting corners here can be devastating. Real-world example, consider Sarah, a 32-year-old single mother. She decided to skip health insurance to save money. One unexpected car accident later, she faced over $50,000 in hospital bills. Without coverage, she was forced into bankruptcy, losing her home and years of progress. Now compare that to John, who paid for health and disability insurance. When he broke his leg and couldn't work for 6 months, his insurance replaced his income and covered his medical expenses. Instead of sinking into debt, he recovered financially and physically with peace of mind. The difference? One saw insurance as a waste. The other saw it as protection. How to avoid this mistake? Number 1, cover the essentials. For most people, this means health, life, auto, and home renter's insurance. These protect your health, your family, and your biggest assets. Number 2, match coverage to your life stage. A single young adult doesn't need the same level of life insurance as a parent with 3 children. As your life changes, adjust your policies. Number 3, shop around. Don't just take the first policy offered. Compare coverage, limits, and costs. Sometimes paying slightly more gives you far better protection. Number 4, review annually. Each year, check whether your insurance still matches your needs. A new job, new car, or a new child all mean your coverage should change too. Mindset. Shift. Think of insurance as a financial safety net. You may never fall, but if you do, it prevents disaster. It's not an expense. It's protection for everything you've worked so hard to build. We don't buy insurance because we expect bad things to happen. We buy it because we know life is uncertain. That peace of mind is worth every dollar. Neglecting insurance might save you a little money each month, but it could cost you everything when life takes an unexpected turn. Insurance isn't about paranoia. It's about ensuring you and your family are safe, no matter what. So before you dismiss it as too expensive, remember, the real cost is what happens if you don't have it when you need it most. Money mistake number 8, not tracking expenses. Have you ever reached the end of the month and wondered, where did all my money go? If so, you're not alone. For millions of people, the struggle isn't about low income. It's about poor awareness. They earn decent salaries, but because they don't track expenses, they lose control over where the money actually goes, why it matters. When you don't track expenses, you're essentially flying blind. Little purchases that seem harmless, a coffee here, a streaming subscription there, a spontaneous online order, quietly add up. Over time, these money leaks drain hundreds or even thousands of dollars each year. The problem isn't just overspending, it's the stress that comes with it. Without tracking, you constantly feel broke, even if you're earning enough. You can't save properly, you can't invest confidently, and you're left wondering why your hard work never seems to translate into financial progress. Real example. Take a $10 lunch at work. It doesn't feel like much in the moment, but if you buy that lunch 5 days a week, that's $200 a month, or $2,400 a year. That's money that could have paid off debt, gone into an investment account, or even funded a vacation. Now, imagine combining that with unused subscriptions, $20 a month here, $15 there, impulse online shopping, and takeout dinners. Suddenly, you're leaking $5,000 or more every year without realizing it. Contrast this with someone who tracks expenses. The same $2,400 from lunches could be cut in half by meal prepping, freeing $200 for investing. Over 20 years with compounding, that small change could become tens of thousands of dollars. The hidden costs of not tracking. You live paycheck to paycheck, because money vanishes without a trace. You build up credit, card debt since you're spending blindly. You miss opportunities to save and invest because you don't see what's left. You feel constant financial anxiety because you lack clarity. How to fix it? Number 1, track everything. Write down each purchase for a month or use budgeting apps like Mint, YNAB, or Pocket Guard. Awareness is the first step. Number 2, categorize spending. Divide expenses into 3 categories: needs, rent, food, bills, wants, entertainment, dining out, and savings, investing. This breakdown shows exactly where your money is going. Number 3, review monthly. At the end of each month, review your spending. Look for patterns. Are you overspending on dining out? Do you have subscriptions you don't use? Number 4, set limits. Once you spot the leaks, put caps on them. For example, limit dining out to $150 a month or entertainment to $100. Number 5, automate savings. First, Pay yourself before you spend. Set up automatic transfers into savings or investments so you're building wealth before the leaks even start. Mindset shift. Some people resist tracking because they think it's restrictive, like putting themselves on a financial diet. But the truth is the opposite. Tracking actually gives you freedom. You don't have to feel guilty about spending when you've already set limits and know you're still on track. Think of it like a fitness tracker. It doesn't stop you from eating dessert. It just shows you the bigger picture so you can make conscious choices. Money works the same way. Tracking helps you align your daily decisions with your long-term goals. Not tracking expenses is like trying to lose weight without knowing what you're eating. You can't change what you don't measure. By tracking your spending, you gain clarity, stop waste, and start directing your money toward the future you want. So, if you've never tracked your expenses before, start today. Do it for just 30 days. Write down every dollar and see what patterns emerge. You'll be surprised and empowered by what you discover. Money mistake number 9. Following the crowd. It feels safe to do what everyone else is doing. If friends are buying houses, you want one. If social media is buzzing about a hot stock or crypto coin, you feel pressure to join in. This is called herd mentality. And financially, it's one of the most dangerous mistakes. When you follow the crowd, you usually arrive late. By the time everyone is investing in a trend, the price is often at its peak. When things go wrong, the same crowd panics and sells at the bottom, locking in losses. Herd mentality doesn't just affect investments. It shows up in lifestyle, too. People overspend on cars, vacations, or gadgets because everyone else has one. Think about the housing bubble of 2008 or recent crypto hype cycles. Millions bought in because everyone was getting rich. When markets crashed, those same people lost fortunes. Those who ignored the noise and stuck to their plan came out stronger. How to avoid this mistake? Define your own goals. Focus on what you want: retirement, debt freedom, or financial independence. Don't copy others blindly. Research before you act. Never invest or buy just because others are doing it. If you don't understand it, don't put your money in. Be comfortable standing out. Remember, most people are broke or stressed about money. Doing what they do won't make you wealthy. Wealth isn't about fitting in. It's about making decisions that serve your long-term vision. It often means being disciplined when others are careless and patient when others chase shortcuts. Following the crowd feels safe in the moment, but it's often the fastest path to regret. If you want financial freedom, stop looking sideways and start looking forward. The crowd spends to impress. The wealthy plan to progress. Money mistake number 10. Relying on only one income stream. For most people, income means one thing: their paycheck. The job feels secure, the monthly salary feels reliable, and it's easy to believe it will always be there. But here's the truth. Relying on a single source of income is like building your financial house on one shaky pillar. If that pillar cracks, whether through layoffs, illness, or economic downturns, your entire financial structure can collapse overnight. Why it's dangerous. Think about it this way. Your employer controls your paycheck. They can downsize, cut hours, or even replace you with technology. Entire industries can change in a matter of years. Relying only on your job doesn't give you security. It gives you dependency. True financial freedom comes from building multiple streams of income, so your future doesn't depend on a single decision by someone else. Real-world example. During the 2020 pandemic, millions of people lost jobs with no warning. For those who depended only on one income stream, the situation became devastating. Rent and bills piled up with no backup. But others who had side hustles, freelancing online, selling products, or earning passive income from investments, at least had something to soften the blow. The difference between panic and resilience often came down to diversification. The benefits of multiple income streams. Number 1, security. If one source fails, others keep supporting you. Number 2, faster wealth building. Extra income can go straight to savings, debt payoff, or investments. Number 3, freedom. With multiple streams, you don't feel trapped in a job you hate. You gain choices. Examples of extra income streams: You don't have to build a giant business. Even small amounts matter. Some options include freelancing or consulting. Use your skills to earn outside of your job. Digital products. Sell ebooks. Templates or courses. Investments. Dividends. Index funds or bonds can create passive cash flow. Real estate. Renting out a room, owning a rental property, or even Airbnb hosting. Content creation. Blogging, YouTube, or podcasts can grow into income over time. E-commerce, drop shipping, print on demand, or selling on Etsy or Amazon. How to build them. Number 1. Start small. Pick one side hustle and grow it slowly. Even $200 extra per month is $2,400 a year you can save or invest. Number 2. Use your skills. Think of what you already know. Writing, design, teaching, or even just knowledge of a hobby can be monetized. Number 3. Automate passive income. Reinvest your savings into assets that earn for you. Over time, your money works harder than you do. Number 4. Scale gradually. Once one income stream is stable, add another. The goal is not overnight success, but steady growth. Mindset shift. Think of your income as a table. With only one leg, it's bound to fall. With 3 or 4 legs, it's stable and balanced. Multiple income streams are those legs. The more you have, the sturdier your financial life becomes. Closing thought. Depending on one paycheck may feel safe today, but in reality, it's one of the riskiest financial positions you can be in. By building multiple streams of income, you create security, freedom, and wealth that no single employer can take away. Remember, one income stream is survival. Multiple income streams are freedom. We've just gone through the top 10 biggest money mistakes people make, and more importantly, how to avoid them. From living beyond your means and not building an emergency fund, to neglecting insurance, following the crowd, and relying on only one income stream. Each of these mistakes has the power to quietly drain your wealth and keep you trapped in financial stress. But here's the encouraging truth. You don't need to be perfect to succeed financially. You just need to be consistent. Small, steady steps matter far more than giant leaps. Most people stumble not because they don't earn enough, but because they don't manage what they already have. Think about it. Avoiding debt puts more money back into your pocket. Tracking expenses gives you control and clarity. Investing early builds wealth quietly over decades. Insurance protects everything you've worked for. Multiple income streams give you stability and freedom. Each of these actions might seem small in isolation, but together they create a financial foundation that can carry you through any storm. The biggest shift you can make is a mindset one. Stop thinking of money as something you chase and start thinking of it as a tool you control. Money is not the goal. Freedom is. Money simply buys you options. The option to work less, to spend time with family, to travel, to give generously, and to live life on your terms. So what's next for you? Don't wait until tomorrow. Start today. Pick one area you know you can improve. Maybe it's creating a budget. Maybe it's paying off a credit card. Maybe it's opening an investment account with just $100. Whatever it is, take that first step now. Because over time, small actions compound into massive results. If this video resonated with you, hit the like button, subscribe to the channel, and share this with someone who needs to hear it. And I'd love to hear from you. Which of these money mistakes have you made before, and what change are you committing to right now? Drop your answer in the comments. Your story could inspire someone else. Remember, the best time to fix your financial mistakes was yesterday. The second best time is today. Your future self is counting on the choices you make right now.